All right, folks, welcome back. We're going to continue our discussion we had from last week, and we're focusing on intraday scalping in the Forex market. Real quick, I covered the architecture of the daily range, the open, high, low, and close, mentioned draw and liquidity, and institutional order flow, and we were focusing on a bearish market environment where the daily range would typically look like this if it was open, high, low, close, and many of you, like myself, have transitioned into candlesticks, so your chart would look a little different. It would look more like this. We were focusing in on the euro dollar, and this is the area at which I was trying to frame the context. The old high, the low, this sell-off in here that would attack the orders below there. Optimal trade entry here. 62, 79% retracement levels, 70.5. The idea is that this is where we would expect to see it sell off. We'll wait for confirmation here. And this is the origin of the swing, and we're aiming for this down here for the sell stops. I had you focus in here from this day to this day, and I wanted you to go down into either the 15-minute or the 5-minute charts and look at the New York session and or London session optimal trade entries. I gave you the outline of what it would look like on the lower time frames. And now I'm going to take you into it here. So this is the first day of 6 days under study. So this very day here is the first one. Second, third, fourth, fifth, and sixth day, which is delivered underneath this low. So just make sure that you understand this red line here denotes this old daily low. This old low here on your own charts, you want to note that, draw that out in time, because if we were up here and we were expecting price to be driven to this level here, is it going to be one candle that gets there? Of course it could be. Is it likely to? Probably not. Is it going to be all down close candles? It could, but will it? Probably not. So you have to learn to anticipate up close days in higher time frame charts like the daily. So it isn't always going to be down closed candles. You might get these types of environments here, which set up instances where you have to sit on your hands and wait, not force trades, not force the issue that you want to be trading and you think it's going to go here. So therefore, every day is an opportunity to be selling. It isn't. But this low here, extended out in time, when it starts to trade through that low again after it retraces, it's going to accelerate. And as we get closer to this low, the more likelihood that the speed of the delivery will increase, and it'll rapidly try to reach to this low and below it. All right, so our first day in here, here's the London high, the New York high. If you look at the high to low, the retracement up in, I said that we were going to use the 62% retracement level and then 5 pips above the old high. What are you aiming for? Well, you have a time window. You have to be out of the trade by 11 o'clock unless you get to that point that I outlined on the daily chart when we start to break that old low again, because things would accelerate on the downside should it break that low again. All we're going to aim for is 1 pip below the old low. Real simple. 5 pips above the old high for a short protective stop. 1 pip below the old low for a limit buy order to take profit. And or 11 o'clock. And here's 11 o'clock. You can see we just make it underneath ahead of that window there. So what's the short? We're selling short here with a stop there, and we're trying to take profit there. That's a nice little scalp. Framed in the context of risk to reward, if you'd like to hold true to those types of things. I don't necessarily believe in it. I know a lot of you said, what did you just say? If you go through the charts and you're trading with higher time frame order flow, you're going to have a higher strike rate. Not perfect, but you'll have a higher strike rate. If you look at time elements like this, and understanding how the market retraces back up in just to go lower, that's intraday swing trading. So we're going to focus on the fact that we're working with time-based rules, and we're looking for logical levels to enter and logical levels to exit at. And we're not trying to hit home runs. The next setup in here, we have an old high, trades up into it in London, and 62% retracement level here, entry, 5 pips above that. This is your target here after you break this low. So when it starts to go lower, we have all this time in here that we can hold the trade. So yes, this is your initial level where you can take a partial profit, but then you have this level here you can aim for. But it breaks it here with a lot more time left in London session that you can capture all of this in here. Will you capture all of it? Probably not, but it gives you the opportunity to do so. Framing the setup here with a stop up to here, just taking a considerable amount of the position off here and then leaving something on at your discretion as to how long and where you would take it. That's up to you. You can do Fibonacci extensions from this high, this low, up in here, what measurements you would have for your fib. Anything lining up with a 50 level, that'd be a good objective there. 30 could have been a good objective because it's 30 pips below the 2060 level here. So 30 pips below that, that'd be a nice objective, and it still meets the criteria for the time window. You have to be out of the trade before 5 a.m. Then you have this day here. This is that up close day. Nothing in here sets the stage for a sell. It's coming off of these lows aggressively, and there's nothing to frame this in for optimal trade entry. There's nothing in here for the London session, and there's nothing in here for the New York session. So what do? You sit on your hands and wait. But this one up close day on the daily chart sets up another round of selling in the future, which could be the next day or the very next day. That's how I use counter days within the order flow that I'm looking at. So we have higher time frame order flow that's bearish. With the benefit of hindsight, yes, but you weren't with me when I was talking to my students. And I know that you guys don't like to hear things like that, but I like to provide the other side of the coin because I catch a lot of flack from readers and viewers that just think they see this side only and they don't see the other side where I'm calling these types of things before it happens. But the way you learn is by doing these types of lessons. They're probably not exciting, but it's how you learn. Okay, and then the very next day, we have a run up in here. No optimal trade entry, nothing framing that. Now, why wouldn't we trade this? Because we have this area that's way too clean. It runs up, breaks down, and runs up one more time. You might take this as an optimal trade entry, but if you do, you have to chalk that up as a loss. And there's nothing wrong with that. I don't see this as a trade, but you can use this as a potential losing trade. So that way we're not looking at everything perfect in hindsight. Don't have anything in optimal trade entry here because on the end of the day of New York at 11 o'clock, we don't have the setup forming. Another no trade day. And here we have this day where we have the high, the low runs up into New York session. This is also one as well, but I'm electing to use this one here. This is a much nicer price swing and retracement. Price breaks down around that 120.25 levels where that old low was. And notice how it happens. We break below it here. And we're in close proximity to that old daily low, which we were targeting. So yes, you can take something off, but this is when you anticipate the market to run aggressively or hard. And it does so here, and it attacks that old low in the daily. And then the next day, it trades below it. From a risk to reward standpoint, your entry at the 62% retracement level, 5 pips above the old high. Nice numbers here. So in summary, when you're looking at scalping, you want to obviously outline a model with time-based rules. So what time a trade begins, what time a trade ends, what filters are you using. It'll help you build a closer narrative to what order flow is doing, and you won't try to jump in impulsively. You want to limit your risk in a uniform way, 5 pips above old high when you're shorting, 5 pips below an old low when you're going long. And you're taking profits, quote unquote, hypothetically speaking, at logical levels. Where are we looking to take profits? at old lows when short, at old highs when long. Understand why there is no setup. So when you're having deep retracements, just anticipate that as a up close day in the daily order flow in the context of a bearish market order flow. Every day in a downswing isn't going to be down closes all the time. You'll have 1 or 2, maybe even 3 up close days, and then it'll wash out lower and go continuously to your objective. Know when it's likely to run hard. Looking at your higher time frame charts and seeing where they're going to reach for liquidity, that helps frame, and this is what a lot of my students get fascinated with when they watch me trade. How do I know when it's going to make a big move? Well, a lot of those things are linked to liquidity and time, but if you're using a daily chart like I just showed you here, it makes it easy to anticipate when these big, hard, fast runs occur. Your unique model resides in this. This is all you need. You think you need indicators, you think you need all these bells and whistles. Everything I'm showing you here is exactly how you make your own trading plan, your own trading model. Taking small pieces from the things that you learn on this YouTube channel can flesh out this rough skeleton. And believe me, if you put the time in, you can turn this into something extremely consistent. And what you can do with it beyond that, the sky is not the limit. Until I talk to you next time, good luck and good trading.